In our previous lesson, we looked at fiscal policy and how that blends in with monetary policy. In our current lesson, we will discuss expectations theory. But first of all, how do expectations affect the market? Assuming that the market is efficient and information is instantly and freely available to all market participants, we could also reasonably expect the market to discount everything in advance. Given the importance placed by the market on the actions of central banks, as analyzed in the previous lesson, it's understandable that expectations of future changes in central bank policy are one of the main factors moving the currency market. Assume that you have $100,000 you want to save. In Australia, the interest rate on deposits is 2%, while in the Eurozone it's 0.5%. Where do you save your money? In Australia, obviously. But if you expect that interest rates in Australia will be cut to 0% by the end of the year, Eurozone suddenly seems more attractive. For example, if investors are convinced that Australia will cut interest rates, will they wait until after the cut happens in order to move their money out? Probably not. If they are convinced it will happen, they are likely to move their money out beforehand and avoid any losses. That is likely to result in the Australian dollar weakening without anything happening yet. Hence, expectations do matter. Yet expectations do matter for stock markets as well. For example, you own a Netflix stock, which is currently worth $140, but you think that the company could go bankrupt next month. Do you wait until it closes down, or do you get rid of your stock right now? Mind you, your stock could be worthless by next month. So you sell your stock now. But if enough people think like this and sell their Netflix stocks at the same time, the price of the stock collapses and the company probably closes down even faster, which is a self-fulfilling prophecy. And the idea definitely has an application on the release of economic data as well. For example, Eurozone's GDP growth rate for Q4 is due to be released. In Q3, growth was 0.5%. In Q4, forecast is for an acceleration to 0.7%. What should happen to EUR/USD if growth is actually 0.9%? The pair will probably move higher, as investors will have to readjust their expectations and price in due to the fact that the Eurozone grew by more than what they expected. What should happen to EUR/USD if growth is at plus 0.4%? It could decline as investors realize the economy did not perform as well as they expected. What should happen to EUR/USD if it's at plus 0.5%? Again, it's likely to fail. Why? Because even though the block grew at the same pace as previously, the market expected more. What should happen to EUR/USD if it's at plus 0.7%? In theory, nothing much. This is what was already anticipated, so it's unlikely to be a shocker. Generally speaking, sharp moves in Forex markets occur on big surprises such as the Brexit vote in the UK or Trump's election back in 2016. If everyone expects something to happen, they position before the event. Thus, if the event actually plays out as expected, very little may happen during and afterwards in terms of market action. But if very few expect something to happen, and it does, we usually see sharp moves in the following minutes, hours, or even days, as investors reevaluate their views and reposition accordingly. In our next lesson, we will discuss specific indicators to watch for macroeconomic data, making a start with indicators for growth and output.